hey everybody, this is Dawood from AutoMarketplace. We have Dan from INSHUR, which many of you know, but he can speak more to it. Dan, thanks a lot for joining us.
My pleasure. Thanks for having me on. Looking forward to this.
And so just as a background to our audience, I was one of INSHUR's first customers when I used to run a fleet more often. So I used to stop by in Dan's office a lot. I know a lot of you who subscribe to AutoMarketplace are complaining about insurance rates. They're going up. And so Dan is probably one of the top, if not the top, one of the top 5 people in New York who can answer questions about that. So Dan, I'll let you do most of the talking, but I'll just pose the questions for you. I think for our audience, it might be helpful to give a background to what you did before starting INSHUR and why you started INSHUR and what problem you were trying to solve.
Yeah, sure. I started my career on Wall Street. I was working in technology, building stuff for hedge funds. After the great financial crash, it kind of became sort of a non-interesting place to work, and I decided to sort of branch out and look for other opportunities. My family, like I'm an immigrant, my family comes from Russia as well. And so, a lot of folks in the community, drive a cab to get to the American dream. And I had someone in my family that was involved in the insurance space, and they happened to sort of cater to taxi and livery drivers in New York City. And they asked me if I could come and help out for a bit. And I just saw like there was this massive opportunity happening in New York City. This was around 2016, 2017 or so. I noticed that there was like this new class of, essentially taxi livery for hire driver that was emerging. These were mostly kind of folks working with Uber, with Lyft, with Get Taxi at the time, and other rideshare apps. They were a lot younger. They came from a different place. And they were having trouble navigating sort of the insurance requirements, and the process at the time. It's gotten a little bit better, but the process just felt super barbaric to me. Like, these TLC drivers had to like come to a broker, park their car, find parking, pay some parking tickets.
It hadn't changed since like the 1980s, you're saying, is like basically like that sort of thing.
Yeah, and the idea at the time was like, hey, can we just make a digital version of an insurance broker in New York City that made the lives of these immigrants easier? And I think the other thing that I was trying to solve for was there was a lot of distrust between the drivers and the brokers. It felt like adversarial. The drivers like didn't speak English all that well, and they didn't trust, like they felt like they were getting ripped off. And I just thought, hey, if we just build a very transparent digital app, a lot of that distrust could go away. And so that's essentially what we did in 2016 and 17. The version of the app has gone through a lot of different iterations since then, but that's sort of the genesis story. And I think, if I remember correctly, you're one of our first customers. You may have been like the top 10 customer at the time. So definitely got a chance to speak to you and pick your brain, which was great.
Yeah, no, I think, and obviously now you've grown exponentially since those days, and although we'll focus on New York City, just so people know, you guys are doing insurance in Europe. I think you bought ABI, another insurance company, you've launched in Arizona. So just for our audience, you're just not a New York City TLC insurance company anymore.
Oh, yeah, well, what they say is like if you could make it in New York, you can make it anywhere.
Yeah,
So
that's true.
we started out in one of the toughest markets in the world. But yes, we're now a venture-backed company. We've raised a little close to $50 million of venture funding to date. We're a team of about a little over 200 folks, split between mostly US and Europe. We focus on the on-demand economy. The vision behind the company today is we think the world is on demand. So we get our food on demand, we get our rides on demand, we get packages on demand. And so the insurance is a big part of the on-demand economy. So we work with companies like Uber and Amazon and Turo across markets in the US, in the UK, and also we have a presence in mainland Europe as well. And we essentially operate as an agent for a bunch of reinsurers that we work with and partner with. And we also are responsible for claims handling as well. So we're very in tune with like what's going on With claims, I would say that claims is kind of like how the sausage is made in insurance. Nobody wants to know what it is, but this is the heart of how insurance actually works. So it's definitely been a journey. We don't do just rideshare insurance. We also do kind of courier, last mile delivery insurance as well. And car share is also an exciting new area of insurance for us as well.
No, that's great. And, congratulations on all that success. I know starting a business extremely difficult. So to get to where you're at is not an easy feat. So really well done on that.
Thank you.
So getting into kind of what I think a lot of people are going to be interested in is the New York City TLC insurance market. And just to kind of low hanging, kind of the initial background questions, how would you describe the market? Drivers and fleets are constantly complaining about the lack of options. There's only a handful of options. And I want to ask you a little bit of a question that the drivers might not appreciate. Given it's a limited market, there's only so much growth in the market. Does it make sense that there's a limited amount of options, or should there be more options? How do you think through that? How would you describe, to a guy, I'm sure you've had it 1,000 times, he walked into your office as Dan, why is the insurance so, why is it up 10% again? Like, how do you explain that to them?
Yeah, it's a great question. So what I would say is commercial auto insurance in general is a very difficult line of insurance. And so what you tend to see across the entire US is specialty niche insurance carriers and program managers that specialize in this place. What makes New York City particularly challenging is a number of things. Like first, it's probably the largest transportation market in the US. It's packed. So you have a lot of pedestrians, you have a lot of cyclists, you have a lot of vehicles, and it's a hectic place. And so accidents happen all the time. So it's just a difficult market from that point of view. Secondly, like the market is all around transporting passengers. And when you get into an accident, those passengers get injuries and they damage things. And so that makes it even more challenging. And then from a regulatory point of view, I would say there's things that could be improved in terms of how the market is structured as well. And you combine all this together and it becomes a pretty challenging place to do business. It's a huge market. It's approaching almost $1 billion of premium across, if you look at all passenger transportation in sort of New York State, it's a big marketplace. And it's growing. It's obviously it's had a lot of growth since the rise of Uber and Lyft coming into New York City. But you obviously have new entrants like Revel, and you have new licenses, EVs being issued. So I would say it's a challenging place, and we could get into like why it's challenging, but there's a number of things that make this a pretty tough place to do business.
I mean, I think that's the perfect transition. Why, as an insurance company, you're seeing all the claims, you're seeing, a lot of drivers might have a perfect record and say, why is my premium up 10%? I didn't do anything. But on your side, that'd be interesting to get your observation and take on why is it challenging? Why are rates going up as they are, even though a driver might never had an accident in 5 years?
Yeah, I mean, so typically, the way that insurance works, right, is it's a law of averages. It's a law of large numbers. So you may have a driver with a perfect record, never got into an accident. But the fact is, if you look across all the drivers in the marketplace, accidents do happen, and they happen a lot. I would say what makes the cost particularly high in New York City is the fact that no-fault insurance, or sometimes called personal injury protection, is a big part of the equation of what makes...
What's abbreviated as PIP usually. Maybe some people know that as from that term, yeah.
PIP, right? So in New York City, all TLC vehicles are required to have $200,000 of PIP coverage. That particular line of coverage is rife with massive amounts of fraud. And you kind of have an industry of bad actors that not only try to extract as much money from this PIP coverage as possible from the insurance company, but also there are tons of kind of personal injury firms that represent potentially injured, potentially not injured parties to extract as much money as possible from the insurance company. And so all of that just adds to the cost. So what may look like a fender bender to a particular TLC driver could actually cost, you know, $200,000 of PIP and $100,000 of bodily injury coverage. And there's all kinds of other things. And so unfortunately with PIP, the way the regulations are structured, and by the way, this is not a New York City thing. This is like across New York State.
Got it. Yeah.
There's just much more, you know, there's a lot more passengers at stake here. This is a problem area, and like I know the insurance department in New York is looking at this. We've spoken to them about it, but it is essentially giving adverse parties a credit card to run up medical bills, and the insurance company really doesn't have a way to combat that apart from scheduling all kinds of examinations with doctors that cost a lot of money. And so this is kind of like getting into an insurance nerd territory, but I think this is a big part of the problem.
And just on that, when you talk about that, that's mostly coming from the passengers involved in the accident. It's not necessarily, I'm sure some drivers might be unfortunately engaged in fraudulent, litigious activity, but it's mostly, you're saying the non-TLC drivers in that, really.
It's the adverse, like, so it's the party that we potentially hit or we get hit by. It is the passengers in the back of these vehicles. It is the pedestrians on the sidewalk. It is the cyclists. And so most of the time, the drivers themselves are actually good actors. Like what we find is TLC drivers are hardworking, mostly immigrants. They just want to put food on the table, make a living. Most of them are covered by the Black Card Fund, which is essentially a replacement for this PIP coverage. But yes, I would say that it's mostly kind of other parts of the ecosystem that result in these claims.
Okay, no, that's interesting. Another question that we get a lot is the concept of a broker. I think a lot of a traditional insurance broker takes, 6 to 10% of, the premium. And so these days, as it goes up, another party that a lot of drivers are accusing of, being an unnecessary middleman is, why can't we just deal directly with, insurer is actually a different kind of class, but, in big insurance company A, big insurance company B, how come we can't deal directly? How would you explain that to a driver, what the value of a broker is, and perhaps how you think about it and why that exists, and is it really affecting premium?
Yeah, it's a great question. So what I would say is, in general, across the US, the way that insurance is transacted is you kind of have like different types of insurance companies. Some companies, like for example, Geico, sell directly to consumers on a website or a phone, and there's no like independent agent or broker network that they distribute their products through. And then others like, Travelers and Hartford and other like big insurance companies you probably have heard of rely on independent agents. And the value really of an independent agent or broker is, they have the interests of the customer at heart. They're supposed to verify coverage and then shop it around the marketplace and offer some good options for the customer. And they're supposed to handle customer service, handle claims, help with claims, and sort of be a sort of advisor and someone that understands the nuances of the insurance industry for the customer. What makes it slightly different in New York City is there is essentially a duopoly that exists in the marketplace. There's probably what, like 3-4 insurance companies maximum.
And I mean, we can just speak plainly, by the way, because we've written articles about it. There's 2 companies for everybody knows is American Transit and Hereford. That's the duopoly.
Yeah, I mean, so what I would say is like, there's not a lot of shopping around that happens because there's essentially, a couple of carriers in the marketplace, and the coverage that's required is sort of prescribed by the Taxi and Limousine Commission, right? So by the regulator. And so I would say that like that is the role of an independent agent or broker. That is what they're supposed to do. I think the New York City marketplace is slightly different, and so does that mean that agents and brokers add value in this place? I don't know. I'm sure they do. We distribute our products through INSHUR directly to the customer, so we act as an agent on behalf of the insurance companies that we work with, and we'd like to have that sort of direct relationships. In other markets, we do use agents and brokers, so I don't want to say that this is necessarily like different from the way that we operate as well. I just think in the New York City marketplace, structurally, it's a little bit different.
Yeah, and just so people understand, and maybe this is also for my own understanding, insure is, we don't have to get too technical with it because we're trying to keep this, not a technical insurance podcast kind of thing on the technicalities, but you don't have a balance sheet per se in which you're underwriting. So I think a lot of people say insure might be, is the insurance company. You're kind of this hybrid broker. Is that how, I mean, I'm sure you've pitched it many more times than I have. How do you explain that to people where you say that, well, we're not the insurance company, but we connect you to other insurance? Like, how would you explain that to someone?
Yeah, sure. So you kind of in the industry, you kind of have like agents and brokers on one side. An agent represents the insurance company, a broker represents the customer. So in New York State, there's a little bit of a nuance there. Then you have a carrier. So like Hartford, Progressive, they're all carriers. That's on the other side. In the middle, there's this new class of, I guess it's not new, but there's a different way to distribute these products. It's called a managing general agent. And we essentially have delegated authority from carriers that we work with. And we essentially bring capacity to the marketplace. We have binding authority to issue those policies, underwrite them, price them. The other thing that makes us slightly different is we also adjust the claims on our carrier's behalf. So we're not a balance sheet. We're not licensed as an insurance carrier, but we kind of look and smell like one to a customer is the best way I would sort of put it.
No, that makes a lot of sense. And then another topic that a lot of people, I'm sure a lot of banks, if they listen to this, will be extremely interested, is no one gets comprehensive and collision coverage in New York City. It's like kind of this dirty little secret that's coming out where the person who's giving the loan, like, just so people know, everybody knows this, when you get an auto loan, almost always, they would require you to have full coverage insurance. So how do you think about that market? Do you think that's going to change, or do you think it's going to be status quo? Because a lot of drivers are kind of like, especially drivers who just bought like a 50,000 Model Y, they can't even get full coverage right now. So even if they wanted to get it, they can't get it. So how do you think about comprehensive collision? What's your pitch to drivers in terms of getting it or not getting it? And how do you think about that market in New York City?
Yeah. So this is a super important topic. I think, I think this is actually a place where agents and brokers really need to do a better job. What we find is drivers and customers in New York City don't really understand the coverage all that well. So your typical liability policy does not provide any first-party coverage for the vehicle that a driver has. So a lot of times drivers will get into an accident and there's this surprise of like, hey, they're not going to pay for my vehicle's repairs, which is kind of different from like your normal personal auto policy
Yep.
that you get from Geico. And so there's a lot of surprises. And I would say that it is the agents and brokers' really job to advise that customer about like, this is an optional coverage. Like you don't have to buy it. Nobody says you have to buy it, but really it's, this is the biggest asset that some of these drivers have, and it is a requirement for them to earn a living essentially. And so I'm frankly shocked by the low levels of penetration on
What would
comprehensive.
you put that at, by the way? What's your estimation of the penetration?
I think in our book, I don't know for the rest of the industry, but I think it's somewhere in like the 25 to 30% range
Oh,
of
wow. Okay. So a 7 out of 10 people don't have the full coverage. And when you say it's not required, just so drivers understand, like the lender, technically they're not uh, they understand what we're talking. When you buy the car, they put a normal DMV plate on it and then they switch over to the commercial TLC plate. Don't the lenders effectively require that, but they just don't check in again? Or is that like a misstatement?
Yeah, I mean, so just like backing up a little bit, when you finance a vehicle or you lease a vehicle, the banks will typically say, hey, you need to have comprehensive and collision coverage because if there's an accident, you won't be able to pay this loan back or this lease because this vehicle will be damaged. So most lenders require the bank to be named as an additional insured on this comprehensive and collision policy. In case there's an accident, they get paid out from the proceeds of this claim. You're absolutely right. I think, the banks, I think probably don't check this nearly as much as they probably should. I mean, at the end of the day, this is a broken part of the entire insurance industry, right? Like a driver kind of gets a piece of paper from an agent and broker, says like, yeah, there's coverage today, but then tomorrow there's nothing stopping from an agent and broker from canceling that coverage. Technically the insurer should be notifying the bank that, hey, this coverage has now been canceled. How much kind of due diligence is the bank doing? I don't know, but
Yeah.
what you're saying is probably not a whole lot.
I mean, yeah, in my experience, I used to get full coverage a lot, but now since the cars are paid off, to be clear, if you have a paid off car, you technically don't need full coverage. But there was two
I don't know if I'd
banks.
agree with that, by the way. I'd say like even if you have a paid
That's
off.
a fair point. But it's not, let's say you're not breaking a financial agreement. When if you have a loan and you don't have full coverage, then you actually, if the bank finds out. But there was two lenders that actually had some sort of database that as soon as I switched over to TLC plates, it triggered it. And they called me and they were like, oh, show us your full coverage. So I was like, okay, maybe they're actually, starting to catch on to this. But I think that's a super important point you're making, especially with a lot of drivers who've gone these new EVs. Now, what do you say to the driver? And I think everybody gets the point we're going to, and he has a Tesla Model Y. He comes to you, he says, Dan, like, whatever cost, I want the full coverage. Are you underwriting like Tesla Model Ys? I'm specifically using that model because it's a very popular model. Are you doing comp and collision for that car?
So I think, are one of the few companies out there that are writing comprehensive and collision for electric vehicles. To be honest, I'm a little bit nervous about it, but we've decided to support the kind of TLC marketplace. What I would say in general is EV collision insurance is very expensive, and the reason why it's very expensive is there's just a lot of cost to that claim, and so. Whereas a traditional sort of gas vehicle, there's 100 years worth of parts, and there's a distribution network. There are repair shops that specialize in repairing these types of vehicles. Whereas electric vehicles are much more newer concept. There's less, if you damage a Tesla vehicle, most times you need to get it fixed at a Tesla shop. And there's not a huge kind of part network available. And so all that sort of adds to the cost. On top of it, like if you nick the battery in an electric vehicle, that could total the car. And so you're talking about a minor accident that could result in a $50,000, $60,000 claim. These are very expensive vehicles. And so all of this is to say is that electric vehicle collision insurance is expensive. I have an EV myself, and I know what it costs me. And
Oh, interesting. What type of EV do you have?
I have a Model Y.
Okay, there you go. Okay. How much is your normal insurance, out of curiosity? Like, how much do you pay for personal insurance for that?
Well, so my limits are much higher than what is prescribed by New York State, so it's probably not an apples to apples comparison. But
Okay, fair enough. Okay, but okay, we don't have to get into that then. That's fine.
Yeah.
So in terms of like, actually, you kind of led into the next question. In terms of electric vehicles, people are thinking about adopting it. You saw the news, but we covered it. That article got a lot of traction about Hertz and them basically they actually specifically tried to rent them to rideshare drivers outside of New York City, and they're like, the math is just disastrous. The depreciation is disastrous. What do you think about EV adoption? You kind of answered the question already in terms of how it relates to insurance. But if a driver like asks you right now that, Dan, I have a TLC plate that you can attach any car to, and I want insurance, would you say, well, think about EV? Like, how do you think about it's kind of a EV question and an insurance question. What advice would you give them, or how would you say you should think about it like this?
So, I mean, the first thing is like, I'm not a TLC driver, so I feel like I'm not qualified to give any sort of advice. What I would say as a EV owner is it's like, personally, I love it, but I live in a house with a garage.
That's
My
it. Yeah.
my EV gets plugged in overnight. I live outside of New York City. And so I wake up every morning with a fresh tank of gas, and I honestly don't really drive that often. A TLC driver operates in a completely different way, right? There's a huge segment of the population that lives in the 5 boroughs. Most places don't have places to plug those vehicles in. And so now you have to rely on the charging network that is pretty scarce at the moment, I would
And there's
say.
right now, just so people know, there's like news, a lot of news articles about like 1 hour waiting lines. We've also observed that. So yeah.
So I mean, again, like I'm not a TLC driver. I don't
Sure.
want to give any sort of advice. I would say everyone needs to do their own due diligence. I would say the city probably needs to do more to incentivize folks to set up charging networks. But absolutely, like I think it's an important part of our transition to this new way of operating vehicles. I love my AV. I think it's awesome. It's clean, and I think we should do everything. I think the city should do everything in its power to make this a successful program. But it remains to be seen. Like I think there's still a number of challenges that need to be overcome.
Getting back to insurance and costs, and I know you can't, in terms of how much things cost, in your book of business, and obviously if you can't share information, let us know, but what would you say individual drivers should expect to pay for liability insurance, and how is it being underwritten? I think that it's a tech, I'm framing it very technically, but if you tell an individual driver that, okay, you're paying 4,000, but another guy pays 5,000, but another guy pays 6,000. What's driving the differences? And what rates are you currently offering to very like pristine, quote unquote, like drivers that have a very good record? What are the rates they should expect at INSHUR? And why is what's driving differentials? So just so people understand why the rates are what they are and why there's differences.
Yeah, there's a lot to unpack there. I'm not sure how much I can cover, but what I would say is, our rates are different from what we see in the marketplace. By the way, if anyone is interested, all insurance companies are required to submit their pricing plans to the insurance department, and that sort of gets approved. And if anyone can't sleep at night, it's like a 300-page document that anyone can get from the New York State Insurance Department. And it sort of outlines how an insurance policy is underwritten. I would say generally in the marketplace, what you will see is the rating plans look at standard rating factors that you'd expect to see at any insurance company. So you look at driving history, you look at how many points are on the license, how many accidents, what type of vehicle, where does a particular person live, is there a driving defense course credit? So all those things kind of go into making up a price. We do things slightly different. I think what makes our product slightly different in the marketplace is we have rated capacity. And that means our product that we sell is backed by a financial rating that's affirmed by AM Best. Most of the other insurance companies in the market do not have AM Best ratings. And that comes with a cost. So we're not always the least expensive option, but we feel like we have a good product and we feel like the coverage is right and we handle claims in a fair manner. And so I'd say, it's hard for me to pinpoint what the average rates should be, but what I could tell you is like there's been a whole lot of inflation over the last, I would say, 10 years. Parts short, like think about it this way. If somebody gets into an accident and now our driver hits a bumper, first of all, you can't always get that bumper as quickly as it used to be. Now that bumper costs like 10, 20, 30% more than it used to be prior to COVID. And so all that sort of adds to the cost of insurance. And so it's hard to say what the average rates are, but I'd say what we see in the marketplace is prices for an owner driver with a great record. I would say somewhere between like $4,000 and $6,000 for liability coverage. Now, the price for collision coverage is going to be largely tied to the value of the vehicle and what type of vehicle it is. But it's difficult to make individual sort of assessments of what the price should be because it's such a regulated and intricate sort of thing.
And just on the no, that's it's kind of an unfair question saying like, what's the average price type of thing, given that if someone is, has 12 points and someone has no points and someone's like more than 3 years, there are two follow-up questions that on the comprehensive collision, the way they calculate that from my understanding is just so people know, it's usually 8% of a car's value. Is that how it's roughly calculated or how is that calculated?
It's hard. It's a percentage of value. I don't know what the number is, and it probably varies carrier to carrier. And there's probably debits and credits for driving behavior as well.
Got it. Okay. And then on and so for this year, for this renewal period, so this is what's going on in the market, and it's we've reported on it. So there's, like you said, there's two dominant players in the market, American Transit and Hereford, and then there's you guys, and then there's Maya. And so Maya is basically increasing its rate. This is our reporting. This is not Dan's reporting, to be clear. Maya's increasing rates maybe 15%. American Transit is 10, 15% plus. Hereford hasn't officially announced their rates. If someone comes to insure and they had insure, let's say before, or they're thinking about even switching from a Hereford or American Transit, is the pitch that you're giving that, well, our rates are going to be much cheaper? Or is it kind of like a different pitch? Is it more like your experience is going to be better?
Yeah, so I think most insurers don't want to compete on price, but the reality is we are in a very price sensitive marketplace. So I totally understand that, like, drivers have to put food on the table, they have to earn a living, and insurance is probably the second most, the second biggest expense that they have. What I would sort of advise drivers to do is to, like, work with their agent or broker or check us out on insure.com and really, do their due diligence on the insurance policy that they're buying. What we try, what I would say our pitch is we have a really great product. It's highly rated by AM Best. I think our AM Best carrier is A rated, which means that there's a financial rating in place. That means that company is likely going to pay its obligations. We try to have a fair claims payment process, right? So we try to settle claims as quickly as possible, at a fair price, and everything is done digitally on our platform. So,
and we'll provide a link to all of this, by the way, in the notes.
You can add your driver in real time. You can report an accident to us through our website. You can print your FH1s. You can download your FH1s. You can add certificates. So we just provide a lot of digital functionality to make the lives of TLC drivers much easier. We've been partnered with Uber in a number of cities, including New York. And so we work very closely with them to craft an insurance product that works for them, works for the driver. And we're very proud of that. And so I'd say we're not always going to be the least expensive, but I think we have a really great product that drivers should check out.
Got it. Well, just a couple last questions, Dan. I know you don't have the entire day to speak to me about insurance. Is in terms of your plans in New York City, so there's some drivers who have sent us statements saying that you may have new partners or whatnot. We've had multiple emails about that. I thought I'd give you a chance to address that because they're asking us and we're like, well, I have no idea what's going on. So what is, I guess, kind of as we wrap this up, like, what are insurers' future plans in New York City TLC? What should drivers expect? And, on those notices, how would you explain that to drivers?
Yeah, so coming back to the way that we operate our business, we are an MGA, which means we work with carrier partners and reinsurers to place this business. Last year, we switched over to another carrier. So Accident Fund is the insurance company that we're now using in New York City. And they've been a great partner for us. They've been involved in the fleet TLC space for a number of years. And so the notices that you're probably seeing is just some, like, regulatory stuff that we've had to send our customers. In terms of plans for expansion, I think, we've been working a lot outside of New York City, but New York City's our home. It's our home base. We love the city. I think it's the best city in the world, and
your London colleagues might not be happy about that. But
oh, they know. So we intend to stay here.
We agree. We agree that New York's better.
Okay, that's good.
We intend to stay here. We intend to create flexible insurance products. We've been actively involved with the regulators to try to change up some of the regulations to make it easier for drivers. We have a lot of ideas. And so I'd encourage anyone to reach out to us and see if we can help. We're always looking to do things in a fresh new way. And so insurance is slow and traditional, but we're trying to shake things up a little bit, and we intend to do that in New York.
No, that's really well said. And just to clarify, you do fleet? I didn't realize that. You also do fleet insurance or just individual operators?
We do insure some corporate accounts, as far as I can tell. I think reach out to us and learn more.
Got it. Okay, fair enough. Okay,
yeah,
fair enough. Okay, and we'll provide Dan's contact details in the notes. Well, Dan, I'll let you have the last word if you want to say anything more about INSHUR. But I think this was really helpful for drivers because right now, people might not know February is the insurance renewals. Obviously, you know this, Dan, is the insurance renewal cycle, and so there's a lot of drivers right now out there who are experiencing 10-15% rate increases. There's been a lot of articles in general, auto insurance is going up. So I think, I'll let you have the last words, but if I'm summarizing what you're saying is that, listen, things are getting more expensive. It's not like if the insurance company increases your rate 10 or 15%, it's not like they're making 10 or 15% more profit. In fact, they might be increasing the rate just to make the same profit as they did before. Is that a fair summary? Because a lot of people will be like, well, he's talking his book, he's trying to justify the rate increases. Is that kind of a fair summary that costs are increasing for insurance companies as well?
Yeah, I think folks would be shocked to realize like what the actual true underwriting margin is in most commercial insurance across the US. And don't forget that these are regulated products. The regulator is required to approve any price changes. And they have to prove like why that rate change is necessary. And so I don't think this is a money grab situation. I do think that, inflation has been rising, parts have been increasing. There's been logistical challenges, and, just costs in general have gone up. And so I think all of that sort of leads to higher pricing, unfortunately. We have some ideas on how to reduce some of those costs. And again, like we've been involved with discussions with regulators on how to make that happen. But totally, this is not a money grab situation. I do think there's significant challenges in the marketplace.
Well, Dan, thank you so much for your time. We'll put your contact details, INSHUR's contact details below if anybody wants to check out your site, especially with renewal season. So thanks again, Dan, for your time. Really appreciate it.
No, thanks for having me on. This has been really fun. And yeah, let's chat soon.
Definitely.